Investors often wonder what drives the price of gold. Although there's no surefire way of knowing where the yellow metal could be headed next, we can learn a lot by looking at these 5 important factors. The first factor is the love trade in China and India, where 40% of the world's population resides. People in these 2 giant Asian countries have a strong cultural attachment to gold that's unlike any other on Earth. Gold coins and jewelry are traditionally given as a gift during important holidays like Diwali in India and Lunar New Year in China. There's even an expression in India: a marriage is not a marriage without gold. And because the middle class is surging in number every year, gold demand for these festivals and celebrations is expected to remain strong. Another factor is central bank policy. Since 2010, global banks have been buying far more gold than they've been selling. This is important because it indicates that gold is so much more than a barbarous relic, but a real form of currency. And right now, central banks are adding more of this currency in order to diversify their assets and protect themselves against their very own policies. Investors would be wise to consider following this strategy for the same reasons. Along the same lines is growth in world money supply. Ever since the financial crisis in 2009, central banks in many countries have taken extreme measures to boost their economies and encourage growth. This includes excessive money printing, which erodes people's confidence in paper money, not to mention dilutes its value. Gold, on the other hand, is one of the most highly valued elements on Earth precisely because it's so rare. Despite the best efforts of alchemists and scientists, gold cannot be replicated in a lab. The only way to obtain more of it is to mine it. This makes gold, in many investors' eyes, more real and therefore more reliable than paper money. That brings us to the next factor: a lack of new discoveries in gold mines. Since 2013, global output of gold has been steadily shrinking as producers continue to cut spending on exploration. Fewer and fewer large deposits are being discovered. The projects that have come online in the past few years are of much lower grade, meaning they don't yield nearly as much gold as older, easier to mine projects. What's more, the number of years between deposit discovery and production is growing because of tougher industry rules and regulations. All of this has the effect of keeping supply growth in check. Gold demand, meanwhile, continues to surge. Finally, there's negative real interest rates, possibly the most important factor. Reason? Gold and real rates share an inverse relationship. When real rates turn negative, gold tends to benefit. But wait, what's a real rate? You can calculate the real interest rate by subtracting inflation from the yield on a government bond. Let's look at an example. Say the US government is paying you 1.5% on the 5-year treasury, and inflation is running at 2%. What this means is the treasury is really yielding negative 0.5%. You're paying to hold the government's debt. When this happens, investors may be inclined to avoid treasuries, which are costing them money, and instead turn toward assets with real value, like gold, thus boosting demand. Again, we can't always know where the gold price is headed, but being aware of these 5 factors can help investors make better, more informed decisions on how to invest their money. Want to learn more about gold investing? Subscribe to our free award-winning investor alert by going to usfunds.com. Thanks for watching.